Hello and welcome to The Trade. Before we get to the charts, let's take a look at international markets. Wall Street, the S&P 500 and Nasdaq closing at record highs on Friday on positive earnings results and expectations of a new round of talks between the US and Iran in Pakistan, which President Trump subsequently called off. Now, for the week, the S&P gained 0.5%, the Nasdaq 1.5% higher, the Dow fell close to 0.5%. Specifically, Intel shares surged to close at a record following a better than expected revenue forecast for the second quarter. Fellow chipmakers AMD and ARM both rallied, while Nvidia closed at a record as it nears $5 trillion in market valuation. Let's get across some technical analysis now. Joining us, Gary Glover from Novus Capital. Gary, welcome back. Good to have you on the show again as we take a look. I've just mentioned there what we've seen on Wall Street going from record to record. We're seeing that with both the Nasdaq and the S&P 500. What are you seeing?
Yeah, very strong action across the US indices, particularly the Nasdaq and the S&P 500 there. I've got an interesting chart here of the Nasdaq there, which is really sort of highlighting these are expanded ranges from the tech wreck. So if you remember, the tech wreck sort of peaked around 5,000, pulled back to about 1,000 points. So that was a sort of 4,000 point decline. So if we sort of expand those ranges higher there, we've sort of found resistance here at the 175, the 275, 375, 475. So we basically keep expanding each time sort of that old tech wreck range there, and we're finding resistance at those sort of key levels there. So we saw it at the 375, we saw it at 475, and we just saw it recently just under that 24,000 zone. But now we've broken through. So each time in the past when we've broken through that key resistance range, we have gone on and gone to higher levels. And the other interesting thing on that chart there is we sort of look at each time, well, the last few times there where we've broken below the 50-day moving average and then recover there. If we recover in really fast time, like we sort of did there in 2020 and 2025, and really get straight back above the 50-week here, then that is a really strong sign there. Normally those markets have gone straight up here. So I know valuations don't look particularly cheap here, but this market's got a head of steam here. And yeah, when we sort of do take off as aggressively as this off the lows there, coming up, if we do pierce that sort of 50-day, 50-week there, come back above, it is a pretty strong sign here. So doesn't maybe, a lot of people are probably a little bit anxious there at the market there. Obviously you've got conflicts there and inflation there, but it is interesting there. If you look at inflation there, normally markets actually go up with inflation. It's only if inflation goes above 5% that the markets can sometimes get into trouble there. So a little bit of inflation is okay. A lot of inflation is not okay. So that's probably the thing to sort of keep an eye on here.
And Gary, does the S&P 500 look as bullish?
Yes, yeah, something like that. Yeah, there has. The key thing there is, and I was sort of highlighting this a few weeks ago to my clients there, is that pullback into the April low has sat on top of actually less spacing between the prior high there in early 2025. So normally like a trend will sort of build on top of each other like a staircase, and that's just a steady sort of strong trend. But if you leave spacing there, if you don't come back to the high and leave space there, that's really bullish. So normally when you sort of see the more aggressive trends, they normally leave spacing there. So we've seen spacing here on the Nasdaq and the S&P 500. Both of those have left a gap there between the last low and the prior high. That just leaves a trend in a really strong position there. So I was saying the last couple of weeks, well, price action is actually really bullish, and it hasn't looked back sort of since there. So we're still in a strong position there. Looking at that range now, I can't see how the market's not going to expand to maybe 100% of that prior range, which is around about 7.4. So it does look pretty firm here. So yeah, I think more than likely here we're going to see sort of higher levels. We've broken through key resistance, and also just the speed of this move, Andrew. That's the other thing too, is that when you come out of the gates here hard, you normally get lots of carry on, and it kind of makes sense of that too, because usually when the market starts to break down and break 50, people start to lighten off and then go to cash. And then all of a sudden, bang, the market's it jumps again pretty aggressively, and everyone's playing a bit of catch up, and then they're waiting for the market to come off. And it doesn't come off, any little dip, they're looking to sort of try and allocate capital again. So that becomes sort of self-fulfilling as well. So pretty interesting price action.
Well, okay, so very bullish on Wall Street. A different story what we're seeing locally. Let's get into some stock specifics, Gary. Beginning with Pro Medicus, which is certainly has been a market darling. It's come off a lot, caught up in that SaaS apocalypse. What are you seeing?
Yeah, with if you go back and look at, say, top 30 growth stocks in Australia there, Pro Medicus, WiseTech, sort of, REA car sales, those 360, those type of stocks there, the 50-day moving average is a really important marker for these stocks there. So once they get above the 50 and they're sort of trading above that, that's when they can sort of really trend. And if they break the 50, from a momentum point of view, you generally don't want to be there. So in the past there, we've seen breaking above the 50 has been a pretty good indicator of actually time to sort of start allocating capital into those growth names there. So, we have just pierced above the 50 here recently. It's the first time there for quite some time there, as you can sort of see on that chart there. You can see the last few times in blue there where we have broken above the 50, and we've normally trended. So these aren't sort of, these are high delta sort of stocks, so they move a lot more than the general market. And they're generally sort of trending. They trend up strongly and trend down strongly. They're probably not sort of stocks that tend to go sort of sideways too often, not to the say that they can't, but breaking above the 50 is a positive sign there. So, we're now looking for sort of to see signs of strength there and keep building higher lows there, but some good signs there for Pro Medicus.
All right. Similarly with Life360 and other stocks that has been under tremendous pressure. Are we seeing a change in momentum there?
Yeah, a little bit of change in character there, Andrew. So we've sort of we've seen sort of clear upward channel, clear downward channels there for these stocks, sort of staying fairly tight channels again, and also that 50-day moving average as well has been important. There has been an important potential change in trend for the stock there. So it has just pierced above here. It's sort of hanging on to the 50 here as we speak. So. But I think if it can hold above the 50 here for the next sort of few days, maybe the next week there, that'll be a good sign there, because again, these are trending high delta sort of stocks there. So they're not sort of stocks that often go sideways there. We sort of see big moves up and big moves down here. So that is a fairly large correction, no doubt about it. But one interesting thing we'll see with those some of those growth names is, Andrew, probably the last 3 to 6 weeks, we have seen volume up. So we've seen probably the volumes have almost doubled, and a lot of those growth names there sort of down here the last couple of months there. So just seeing possible signs of accumulation take place on some of these, sort of strong growth names that have sort of been beaten down pretty badly here.
All right, Gary, let's round it out with a look at the banks, two in particular, starting with NAB. The banks having struggled certainly over the past couple of months.
Have struggled there. So we've seen some increase in doubtful debts and provisioning by the banks, and banks have come out, a couple of banks have come out and made some commentary around the Aussie consumer, just sort of starting to strain and feel the pinch. That provisioning is a little bit of a heads up that there might be a little bit more pain to come here. Just think it's sort of interesting there that we've got that commentary and those that heads up from the banks there. At the same time, we've got a really important technical sort of squaring of the range. So one thing I've noticed over the years is that if we look at a sort of like a 3 or 4 year bull market, before we go into corrective or a pullback in that range there, the one thing I've noticed from an observation point of view is that oftentimes the first leg up in that bull market or the last leg up in that bull market can be 50% of the entire range. And we've just seen here with Westpac and NAB, the last rally here. So you're talking about like a 4 or 5 year bull market. The last 6 months makes up 6% of that, 50% of that whole range. So it's interesting there, because you really got 1, 2, 3, 4, 5, 6 years of building this range there. And the last sort of 6 to 9 months there, you get that fast move up there. And that's how often the highs come in and markets build tops there. So that's an interesting technical point of view, just from a range point of view. But yet the secondary notion there, apart from the commentary, is we're starting to see signs of distribution there. So we're seeing these stocks sell off there with a bit more volume and a bit more gusto in that there. So sort of signs of distribution. So like we're talking about those growth names, the last sort of 6 weeks, we're seeing accumulation at the lows. We're seeing sort of big volume at the highs here, which is sort of sign of maybe distribution, maybe selling there. So not so good signs there for the banks there. So I'd be a little bit wary about financials there moving forward here over the next 6 months. And you look, that they are sort of sitting on you've got banks and staples at the moment trading on mid 20, high 20 PEs. So that doesn't leave a lot of room for upside. And we've got other sectors that are normally, like the growth sector, obviously, those tech stocks are trading probably lower PEs than our banks and staples. So that's telling you a little bit about where the market's at the moment.
Gary, great to get across those charts. Thanks for joining us from Novus Capital.
Thanks, Andrew.
And that is The Trade.